And so I guess one of the things in our process is that until an analyst is a senior analyst, they don't actually do the valuations. And the reason we do that, we think, is because when you do a valuation, you are, as an analyst, you are effectively making a call. It may not be deploying capital, but you are making a call. And we don't think that, certainly not juniors, should not have the pressure of being risk on. It's only as you get more senior that you take on more risk. So, I'm thinking, Jack, sort of, how have you found sort of taking on sort of valuations now, and have you found that as a sort of responsibility? And is there anything you can sort of tell us about that?
Yeah. Well, I think the fact that we have a probabilistic approach to valuation can cover a lot of mistakes in the analysis of companies. Because I think if there are two approaches, one is a probabilistic approach and one is a sort of scenario-based approach. We could have, I guess, a more negative scenario for a business, which drives a valuation. Say, a new competitor comes in, or their new product is a flop. We could have a more bullish scenario where competitors are going bust, customers are giving them a lot more business. That's great, but if those scenarios don't pan out, then that, I think, becomes a very fragile way to value a business. And what I like about our probabilistic approach is that we simply put ranges on what revenue growth could be, what margins could be, and how much capital the company needs to deploy to get to that revenue growth.
Well, I think to tie it back to the thing you were talking about earlier in the quarterly review, and you said we review our assumptions. Sometimes it is a lot easier, well, not sometimes, almost always it's a lot easier to say, this new piece of information that I've just learned makes me reduce the lower end of my revenue assumption, or reduce the upper end of my revenue assumption, or increase the midpoint of the margin. You have more ways to express what you've learned, as opposed to a more binary approach where you're like, oh,
exactly.
Yeah. And I think that nuance is just easier to tie in a new piece of information to a change in a range. Because, we've had this before with many scenarios, Aubrey would remember, where new piece of information comes in and it doesn't change anything except the lower end of margin now could be lower because we've learned something new about it. Everything else is the same. And so it takes, like you said, it gives you more levers to pull to express a specific view. And it doesn't tie you into, I guess, a binary situation, or you're making less of a strong bet, I guess, about something. And it's often, these people just, in my experience, are willing to make much stronger bets than they should, given the uncertainty about what we know about companies in the world.
Absolutely. I think if you're all just having one margin target, if it doesn't hit that, what, is your investment thesis broken? Is your investment thesis broken because it's 1 point under, or because it's 2 points under? At what point? You need to know that in advance. And I think that's one of the joys of having ranges. But I think maybe to touch on an earlier point you made, Jack, is perhaps it takes a little bit of the burden of responsibility and the pressure off by having a range, by not having to be precise, not having to make a precise call. Because there is pressure in having to make calls. And that's a hard thing. I mean, one of the things that I found, and this is a slight tangent, really reassuring, is that investors tend to get it right between 48% of the time and 70% of the time. And even some of the best investors only get it right 48% of the time. And almost nobody gets it right more than 70% of the time. And even those that do are not always the best investors. So, with the best returns. So what that meant to me is, actually, you know what? I'm allowed to make mistakes. I don't have to be right all the time. We can't be right all the time. The question is, how do we minimize it? And not just how do we minimize it, how do we recognize when we're wrong early enough so that it doesn't cause damage, so that we can let our winners run and own them forever, and how we can get out of our mistakes. And I think that having these ranges and this probabilistic approach gives us a much better mental framework to get out of mistakes early and to let our winners run.
Yeah.
And I think the final interesting point about that makes us different is that lots of other firms will have lots of different analysts all building their own models, using different discount rates, using different assumptions, different drivers. We have a consistent valuation model for every business, almost every business, where, as a result, we get a consistent output. And as you once said, it is better to be consistent than to be right.
Yes, I did say that.
But it is true. It is a relative game.
I didn't mean to say it, but
but we are looking for the best value opportunities out of our opportunity set.
Yeah.
And if we're 5% wrong consistently, if we're 5% higher, well, we're still going to pick the best.
Mm-hmm.